Imagine applying for a loan, a credit card, or even an apartment, and instead of a long interview, the decision comes down to just one number, a number that silently follows you through almost every financial decision you make in the United States. That number is your credit score. Most people hear about it, worry about it, and even fear it, but very few truly understand what it is or how it works. Today, we're going to change that. In this video, we'll explain what a credit score really is, why it matters so much in the USA, how it's calculated, and how you can use it to build a stronger financial future, simply and clearly, without confusing jargon. At its core, a credit score is a 3-digit number that represents how trustworthy you are as a borrower. In simple terms, it tells lenders how likely you are to repay money that you borrow. The higher your score, the more confident lenders feel about giving you credit. In the United States, credit scores usually range from 300 to 850. A score closer to 850 means you're re-seen as a low-risk borrower, while a score closer to 300 signals high risk. This single number can decide whether you get approved or denied, and how much that approval will cost you. So, who actually creates this score? In the US, credit scores are calculated using information from your credit report, which is maintained by 3 major credit bureaus: Equifax, Experian, and TransUnion. These bureaus collect data about your borrowing and repayment behavior, things like credit cards, loans, payment history, and account balances. That information is then fed into scoring models, the most common being the FICO score. While there are different scoring systems, FICO is the one most banks, lenders, and credit card companies rely on. Now, let's break down what actually goes into your credit score, because this is where most people get confused. Your score isn't random. It's calculated using 5 main factors, each with a different level of importance. The most important factor, making up about 35% of your score, is payment history. This simply means, do you pay your bills on time? Late payments, missed payments, and accounts sent to collections can severely damage your score. On the other hand, consistently paying on time builds trust and strengthens your credit profile. The second biggest factor is credit utilization, which accounts for about 30% of your score. Credit utilization refers to how much of your available credit you're using. For example, if you have a credit card with a $10,000 limit and you're using $3,000, your utilization is 30%. In the US, lenders generally like to see utilization below 30%, and under 10% is even better. High utilization signals financial stress, even if you're making payments on time. The third factor is the length of your credit history, which makes up about 15% of your score. This looks at how long you've been using credit. Older accounts help your score because they show a longer track record of behavior. This is why closing old credit cards can sometimes hurt your score. It shortens your credit history. In the US, patience is key when it comes to building strong credit. Time matters. Next comes credit mix, which accounts for around 10% of your score. Credit mix refers to the different types of credit you have, such as credit cards, auto loans, student loans, or mortgages. Having a healthy mix shows that you can handle different types of debt responsibly. However, this factor is less important than payment history and utilization, so you should never take on unnecessary debt just to improve your mix. The final factor is new credit, also about 10%. This includes how often you apply for new credit and how many new accounts you open. Every time you apply for credit, a hard inquiry is added to your report, which can slightly lower your score. Too many applications in a short period can make you look desperate for credit, which raises red flags for lenders. Now that we understand how credit scores are calculated, let's talk about why they matter so much in the United States. Your credit score affects far more than just loans and credit cards. It can determine whether you're approved for an apartment, how much you pay for car insurance, and even whether you need a security deposit for utilities. In some cases, employers may check credit reports as part of background checks. In short, your credit score shapes your financial opportunities. A high credit score can save you tens of thousands of dollars over your lifetime. For example, someone with excellent credit might qualify for a mortgage with a much lower interest rate than someone with poor credit. That lower rate means smaller monthly payments and less interest paid over time. On the flip side, a low credit score doesn't just mean denial, it often means higher costs, stricter terms, and fewer options. So, what is considered a good credit score in the USA? Generally speaking, scores are categorized like this: 300, 579 is considered poor, 580, 669 is fair, 670, 739 is good, 740, 799 is very good, and 800, 850 is excellent. Most lenders prefer borrowers with scores above 670, but even moving from fair to good can make a noticeable difference in approvals and interest rates. One common myth is that you need to be rich to have a good credit score. That's not true. Credit scores are not about how much money you make. They're about how responsibly you manage credit. Someone with a modest income but strong financial habits can have a better score than someone who earns a lot but mismanages debt. Another myth is that checking your credit score hurts it. In reality, checking your own score is considered a soft inquiry and has no negative impact at all. If you're new to credit or rebuilding your score, the process may feel overwhelming, but it doesn't have to be. Start with the basics. Pay every bill on time, keep credit card balances low, avoid unnecessary applications, and regularly check your credit report for errors. In the US, you're entitled to a free credit report from each bureau every year through the official site Annual Credit Report. Comda's reviewing your report helps you catch mistakes before they cause serious damage. Think of your credit score as a financial reputation. It's built slowly, damaged quickly, and repaired with consistency. Every payment you make on time is a small vote of confidence in your favor. Every smart decision adds up. You don't need to be perfect, you just need to be consistent. In the end, understanding your credit score puts you back in control. Instead of fearing that 3-digit number, you can use it as a tool to unlock better opportunities, lower costs, and greater financial freedom. Knowledge is power, especially when it comes to money. If you understand how the system works, you can make it work for you. If this video helped you understand credit scores more clearly, make sure to like it, subscribe to the channel, and share your thoughts in the comments. In the next videos, we'll dive deeper into how to build credit fast, common mistakes to avoid, and smart strategies for managing money in the USA. Thanks for watching, and we'll see you next time.